Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
If you're interested in learning more about setting up your own family banking system, send an email to thefamilybankingshow@gmail.com. We'd love to hear from you.
Welcome back, ladies and gentlemen, to the Family Banking Show. We are your hosts, Derek, Rob, and John. If you're interested in learning more about family banking and would like to get started, you can reach out to us at thefamilybankingshow@gmail.com, and we would be happy to sit down and discuss what some of your options are. Guys, in this episode, we're going to be talking and continuing in our series on unveiling institutions, and we're going to hone in on a lot about the banking institution and fractional reserve lending. And by this, we mean commercial banks or, Wells Fargo, Bank of America, US Bank, Chase Bank, whatever. We're going to be talking about fractional reserve lending. Would anyone like to kick us off there and not only talk about what fractional reserve lending is, but what the purpose of this entire series is really about?
Yeah, so I hadn't heard anything about fractional reserve lending before diving into the infinite banking concept. I think just kind of peeling back the layers and understanding what's going on around us that otherwise I just thought was the default. Like there's nothing else really out there that we can do about it, or I didn't even question it. So it's just really, really fascinating, one, and eye-opening too, to see what's going on around us, and particularly right now thinking about the banking function and fractional reserve lending. And I'll just define that because truly is what the title is. So banks are able to lend on a fraction of their reserves. So right now, the general guideline, and I think it's even less now, but we'll just call it for even numbers, it's been 10%, meaning you can, lend out 10 times what you have in reserves, in actual dollars, like in your bank, in your storage, and basically create money out of nothing. And so that we'll get into that more specifically, but I had no idea that existed, and I had no idea the effects of that once I did learn it. So just understanding what banks do, how it affects us, and then what we can do about it, I think is really the crux of what we care about, is what we can do about it, how we can shield ourselves and protect our families from lots of the risks posed in these institutions, and kind of partnering with them more or less.
Excellent. Yeah. And I've been thinking a lot about the term inflation, and obviously it's a common term nowadays of just how crazy prices have gotten. And one of the causes of that really is fractional reserve lending. The fact that banks can lend more than what they have on reserve. In other words, it's kind of a lie or a little hack that the only banks can do. And which is why we prefer to bank with insurance companies rather than using commercial banks for that warehousing function of keeping your cash someplace safe and liquid and accessible. So that's a good overview. Why don't we go ahead? I'm going to share a little bit of a graphic, and I think the numbers of the graphic will help make fractional reserve lending a little bit more sense for our listeners. So let's just turn our attention over there. If you are listening on a podcast app, hopefully the numbers that we're going to talk about make some sense here. So imagine if you were to deposit $100 in your savings account at Wells Fargo, and the reserve limit or reserve requirement of the bank was 10%, which, as John mentioned, has kind of been more of a historic number. I actually looked up today, guys, the reserve is still at 0% for banks, and it's been at 0% since March of 2020.
Wow.
So a bank can technically lend out 100% of their deposits. They don't technically need to have anything on reserves for the depositors of the bank. So in this instance here, you deposit $100, the bank is only going to keep $10 in reserve, and they're going to lend out 90 to somebody else. Well, what does that person do? If they go and purchase a car or anything, that money gets recirculated back into somebody else's bank. And so now that second bank downstream is still only going to hold 10% of that reserve. So 10% of $90 is now $9 on reserve, and they can lend out now $81. And this keeps trickling down and down and down until ultimately there is no more dollars for them to lend out. So what does this do? Well, it causes there to be more money in the ecosystem or the economy than what is truly in reserves at their banks. They're able to leverage 10 to 1, or technically 100 to 1 or 1,000 to 1, because there is a 0% reserve requirement right now. And so hopefully you can see why that causes prices to go up. If people can get easy access to loans and banks can just basically print money out of thin air by allowing more people to take loans from their bank, it's going to cause prices to go up because there's a supply and demand. Just like with housing, if everybody could get a loan, but we can only build so many houses, now all of a sudden the prices of those houses are going to go up, and the value of the loans also need to go up. And so that's what's causing part of the inflation that many people are experiencing in the United States. But this is true for any country or any nation that allows for fractional reserve lending. So I'll pause there, guys. Any other anecdotal notes that you wanted to mention here about this graphic and just the whole concept of fractional reserve lending?
Well, one, like you said, side effect of it is that it inflates the money supply, and then the more dollars that are in circulation, people will spend more for the same thing because, well, now I have more money than I used to have, and I want that thing. I'm willing to pay more for it because I have more money that came out of nowhere. It reminds me of a great story that our mentor Dave tells of. I think it's his boys, where I think they're building tree forts or something, tree forts, I believe, and then they were selling them with acorns or walnuts. I forget, some kind of nut that you could get from the woods. And, it might have been like you cost 10 acorns to buy and sell these forts. Well, one of the boys found like a hoard of acorns or walnuts. It came out and like, I'll give you 20 acorns for it.
Yeah.
And then once the other boys found all these acorns, then it just skyrocketed in acorn cost or walnut cost, whatever that currency was. And I just think that's such a perfect example of how that works, right? If there's a fixed money supply, then the value it's constrained. But when you just pour in dollars, then people have more money. Like it becomes less valuable to them, so they're willing to overpay for the same thing because they have all this extra dollars that came out of nowhere. And so that just really, I think, encapsulates it, real simply, that where inflation comes from, just that injection of cash into the system.
Yeah, and I'll just add two things. One is it speaks to like the security of our dollars being stored in those banks. Like thinking about that graphic, Derek, in that first bank, like if I'm the only customer, which obviously many banks are betting on the the concept that there are tons of customers and only very few of them are going to want their money back, right? They're going to want to withdraw their deposits. But if I'm the only customer and I just gave them $100 to store for me, and then tomorrow I say, hey, by the way, I need to withdraw that $100 back. And they say, oh, sorry, like actually we only have $10. 90 of it was actually loaned out. So then effectively just unable to provide the basic need, the basic function of storing my capital. So that just makes my mindset when I think about storing capital
Mhm.
uh, just totally different and thinking about the security of my dollars in that bank. Um, and then, yeah, the second thing, like I kind of think of it, especially in the framework of infinite banking, of, the banks will store my capital and finance the things of life. You know, if I can just control that part of the function, not to mention all the benefits of, uh, you know, recapturing interest, getting tons of, additional benefits and so forth, but I could just actually contribute just in part to reducing that inflationary effect, then that can be, a very powerful thing. If me and you and everybody else and
Hmm.
maybe millions of Americans adopt this philosophy, it can make a huge dent uh, in that problem, which I do believe it is a problem that literally by design, if you were to watch any of the Federal Reserve and their 8 meetings a year, I believe it is, when they set interest rates, their goal is inflation. Like their goal is a 2% inflation. Like they say that every single time.
Yeah.
Uh, Jerome Powell right now. Um, we'll talk about, yep, we're at 2.5. We want a 2% inflation. It's like we want inflation. Like that's by design, by default, what's going to happen to us. Like we're just, we don't have a choice about it. So anyway, I think that's just fascinating to again peel back the layers and just understand what's going on behind the curtain.
Yeah. Basically, we want to erode people's wealth and devalue our own currency. Like that's what inflation does.
Yeah.
Hmm.
Yeah. So,
Right.
I mean, obviously, people can make wealth with debt, of course, um, and leveraging other people's money. Like, yeah, that's been proven time and time again. But um, there's a way that is honest about it, and then there's a way that's corrupt about it. So I think what we should do next, guys, is probably look at an example here of how do banks make money and just how much are they making through this process of fractional reserve lending. And so it probably doesn't shock our listeners too much. Like if you deposit money at the bank, you will earn interest for depositing there. So that is an expense of the bank is to pay you as a depositor a certain percentage of interest from what you have deposited there. But how do they make money? Obviously, banks then go and lend it out, create loans, and the interest that they're charging on those loans are oftentimes much greater than the interest that they were paying you as a depositor. And so, Rob, I think you were taking a look at an example here today of just how far this goes when each bank can go ahead and continue this process. So, as money circulates through the entire banking industry, what effect does that have? What kind of rates of return are the banks making on us as depositors?
Yeah, that's actually another thing that once after I read Becoming Your Own Banker and then how privatized banking really works, that like blew my mind in terms of how much money banks make. Because I think it's when you look at it from the face value, it seems really kind of straightforward. So I did a little, I just Googled quick and got some rates from some local banks. And so let's say you are up there, they're giving you 2%. So you deposit your money into the bank and they're giving you 2% in terms of interest that they're giving you, which may or may not be true, maybe less, maybe more, but probably not much more than that, to be honest, at this time, early in 2025. And then they turn around and they're like auto loan rates for this bank is 5.39%. So then you go, okay, well, they're paying me two and they're charging 5.39. So the bank is making 3.39%. And well, that seems like a fair profit for the bank to make of my money. But what you don't realize is that's not 3.39% because their cost of it is 2% and their spread on it is 3.39%. So the actual rate of return that the bank is getting on your money is 169.5%. And once that kind of like that someone did this exact same kind of thing, listening to a podcast or presentation, it's like, holy cow, I never realized that. So like they're getting my money dirt cheap. They're giving me nothing for it. It's like buying something for $2 and selling it for $5.39. That's a huge markup. That's a huge profit for the company, the bank. But then here's where it gets worse. Then someone else comes into the bank and they get a loan and since they don't have to, they can use my money, they can 10x my money in a sense. They can make 169.5% on money that they don't even have. So it's just an over and over and over again. And so that's where really you start to think about it. Banks are making these massive profits on money they literally don't have.
Yeah.
Just let that sink in for a little bit. And then if we go back, like the same example, we go back to like a super low interest rate environment when we would get like 0.1% on your deposit. People would think that low interest rate environments are bad for banks, But in reality, it's really, really good for banks because the cost that they give you for your money went from 2% down to 0.1%, but they're lending at a rate slightly lower. So you could get a car loan for 2.99%, let's say. That's a 2,800% return for the bank. So it's just low interest rates are really good for the banks, record profits. And just to think about that, and they can just keep doing that with money that they don't own. It's not theirs. And it just really kind of like blows your mind. Massive paradigm shift when you finally when it clicks in your head about how the banking system really makes money, how they inflate the system, and then they make money off of all this inflated money. It's just crazy.
Yeah,
Yeah,
Nelson Nash used to say banking is the most profitable industry in the world.
Yeah.
And Rob, you've done a good job of trying to illustrate that for us of just, even when rates are low, that's when banks are making the most. And
Yep.
so when everybody's screaming for lower interest rates, well, okay, but who's going to be the one that comes out on top in that scenario? And it's oftentimes going to be the banker, not the borrower.
Right.
and that's just one like turn on the money, right?
Right.
They,
Yep.
I've been told by several people I know who are in the banking business, commercial banking more so, that they expect 20 to 25 turns every year. So you're getting that, say,
Mm.
2,800, call it just, 1,000% return on their money
Mm.
25 times, over a year. That's just incredible on money they do not have. And
Right.
my brother, he was doing a refi on a rental property that he owns, and they had this issue with like, oh, by the way, you have like, one gap in the siding on your garage. So we won't approve this loan until you get the siding fixed.
Yeah.
It's like, okay, yes, there needs to be siding, and that's, a very good best practice to have for owning a home. But my goodness, like you don't even own these dollars that you're loaning out. And you're now like making my brother's life just miserable. He's on deployment at this point. I'm thinking about this time period, and
Mm.
all on money they don't own, and that they're going to profit insane amounts. It's just so maddening to me to think about the requirements and the burden they place on us. Like we've talked about that phrase, hat in hand. We're hoping for this
Mhm.
loan, that they're
Yep.
going to be scrutinizing and approving this loan, but they don't even own those dollars. It's just totally backwards.
Yeah. Right.
Well, it is quite the business to be in. If you're interested in starting a bank, you let me know and I'd like to participate with you because, yeah, I'd like to earn thousands of percent on other people's money. Like, sure, why not? So guys, obviously, I think the next question needs to become, why should we care about fractional reserve lending? If everybody else is doing it, we've been doing it for years. What difference does it make? We've just become accustomed to it. Why should our listeners care about fractional reserve lending and maybe what the next step or alternatives might be?
Well, I'd say the first thing that kind of reminds me of if you read Nelson's book, Becoming Your Own Banker, he plainly calls it out. It's theft. They're taking money they're taking something that is not theirs and they are profiting from it. So it should just rub you the wrong way from the get-go because that's just straight up thievery. And so he's very clear on it. And I agree with that it's just stealing, to be honest. Um, and that's a good question. Like, what do we do about it? I mean, obviously the banking system, we need it. We rely on it. As a matter of fact, if we take out a policy loan, it has to go into a bank. It'll go into a bank first so that we can then use it, for something for an opportunity or, for, some kind of large purchase that we're making for some reason. So you can't get out of the banking system. But if we make whole life insurance our warehouse of our wealth, our storage place for our wealth, they're holding the money, and the life insurance companies do have to place their funds in banks, but banks can't lend out that money. So in our own way, we're removing money from circulation, placing it into a place that can't be inflated, and so we can't get out of the system, but we can do our part in some ways to kind of slow it down and not give it as much fuel by moving our dollars into a non-inflationary location, an asset like a whole life insurance policy.
Yeah, even
Absolutely.
go ahead, John.
No, no, go ahead. Go ahead.
Even if we think about the fact like of these banks, how wildly profitable they are, and if we remove the control of our money from the bank and bring it into a life insurance company, the reserve requirements of a life insurance company are much, much higher than they are for commercial banks. I mean, obviously, right now, a 0% return reserve requirement, anything is higher than that. So by shifting just where we store that capital and the reserve requirements of it, that's reducing the amount of the inflationary pressure that fractional reserve lending can have. And
Right.
so what you would find is, yeah, there would be a reduction in prices. The economy might contract a little bit for a while, and then eventually people become accustomed to the new normal of a higher reserve requirement from the banks. But the other thing too is like, me, yes, I pay premium to a life insurance company and I have access to the cash value in the form of a policy loan. But because I partner with a mutual insurance company, I'm a part owner of that insurance company. And so
Mhm.
every dollar that I maybe pay back in those policy loans in just the form of interest stays inside the company that I'm an owner of. Whereas, what's the flip side of that? Well, Wells Fargo, maybe you get a loan from a bank that you aren't a participant of. Who are you making wealthy? You're making just the bank wealthy and their shareholders.
Right.
But if I am the owner of my own banking system, of the participant of the insurance company, now I'm making myself wealthy through the hands of the insurance company. And there are no other shareholders other than the other mutual owners of the insurance company. So there is no drag on that return. So I think that's just another great example of by choosing where you lend or borrow from, you're able to keep your capital in a system that you're an owner of rather than it going to fill the pockets of somebody else. So you're making your own insurance company more profitable by servicing that debt than servicing the debt for a commercial bank that you can't participate in. So
Yeah, and you're probably getting a better deal, honestly,
yeah,
on the policy loan rate compared to we're talking about wholesale versus retail. Like we're getting the wholesale deal with our policy loan, and the banks have to make that markup even more so than what we would otherwise see with the policy loan. So you're talking about maybe a 6% loan. We could get it wholesale at 5 or something. You're likely to get that better deal.
yeah,
I know we didn't. I don't think we defined it, but we have alluded to the idea of a run on the bank. And that's something for me that, why should I care? I want each dollar that I work really hard to earn to not be subject to an arbitrary run on the bank like Silicon Valley Bank or all the banks that failed back in, 08, 09 crash. And historically, many banks fail due to a run on the bank because of fractional reserve lending and not having the adequate reserves. So I want to make sure, for my family that every dollar is safely stored in what I think most Americans assume is the case at a bank. They assume, oh, it's all
Mhm.
going in the vault or whatever it is,
yeah,
If I ever need my dollars, they'll just come and, bring it right back. That's not the case, unfortunately. And like Rob is saying, I believe that's fundamentally unethical that
Mhm.
they're doing things with our dollars that we don't even necessarily understand is happening.
yeah.
Yeah.
Or every time I check my online balance, it says it's there, so it must be there.
Hmm.
Right.
Yeah,
Right. Yeah, so not only do we love, dividend paying permanent whole life insurance because it has like all these amazing properties. You get the death benefit for your family, so you're protecting your family. The death benefit can provide legacy. It provides estate options. It provides hedges, with other assets to make them better. Your cash value, it grows uninterrupted compounding that you can borrow against. That all these benefits that we love about it, but there's also like in terms of like when I learned this, if any of our listeners are looking for like any other benefit, intangible benefit, the fact that you're doing something that's a private contract between you and the insurance company that is in some way like affecting the banking system and like it's moving that control back into your hands. Like I'm not sure if you guys feel this, but there's a sense, there is some, I don't pride. I don't know if I want to call it pride or happiness or some kind of contentment knowing I'm doing something that's 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 breaking free from the system. So not only am I getting all the benefits of my whole life policies for my family and ourselves, but I'm actually doing it's like like a little bit of a rebellion, against the system in a way. And so there's like that intangible, like, oh, I feel like I'm doing something meaningful, so just thought I'd throw it in.
Yeah, by warehousing your wealth through your own family banking system, not the commercial banking system, you are reducing the grips that they have and the inflationary pressure that can result from fractional reserve lending. So, John, I'll turn it back to you. Any other final thoughts here before we wrap up today's episode?
I think back to what Nelson says, where he said, it's ridiculously simple. And it truly is, where like you're talking about, it's private. It's just me and the insurance company, they can't do things with my money without me approving that. And by contract, by law, I have that access to it and control. And it keeps things very peaceful, keeps things very simple. I know there are tons of other benefits and protections. Helps me sleep at night way better than, before understanding what infinite banking did for my family and peace of mind. So
for sure.
I love it.
All right. To our listeners, once again, if you're interested in learning more about creating your own family banking system, you can certainly reach out to us at thefamilybankingshow@gmail.com. We'd be happy to walk you through what the process looks like. And in the future episodes ahead, as we continue in the Unveiling Institution series, where we're going to be talking more about the gold reserves and fiat currency and income taxes and mortgages. I hope you will stick around and join us for those episodes. Thanks, guys. We'll see you in the next one.
See you guys.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.